Monroe Capital is down, but income investors might want to pay close attention. You're watching Insightful Value, where we go beyond the headlines to explore overlooked stocks and hidden gems. We break down companies in a way that's clear, data-driven, and designed to help you think independently. Today's spotlight, Monroe Capital. This review is for informational and educational purposes only, not financial advice. Monroe Capital, ticker MRCC, is a business development company, or BDC, that specializes in lending to lower middle market businesses in the US. These are typically companies with EBITDA between $3 million and $35 million, which are too small for traditional bank financing, but still ripe for strong returns. What makes Monroe different is its focus on first lien, unitranche, and subordinated debt, meaning they try to structure deals that balance yield and risk intelligently. When the stock is down, dividend investors often perk up. So here's the bait. Monroe Capital is currently offering a dividend yield above 12%. That's not a typo. But the big question is the yield safe? Let's break it down. The company has faced headwinds. Rising interest rates have increased borrowing costs, pressuring net interest margins. Credit quality in the portfolio has shown some cracks, and non-accruals have edged up. That's part of why the market has pushed the stock lower. However, from a value perspective, Monroe trades below its book value, which suggests the market is pricing in a lot of pessimism. The company has tried to maintain its dividend, even raising it recently, signaling confidence in its ability to generate consistent income. On the earnings front, Monroe reported net investment income that covered the dividend, which is always something to watch closely with BDCs. Its investment portfolio remains diversified across industries like healthcare, media, and business services, helping reduce exposure to any one troubled sector. One risk is Monroe's reliance on leverage. Like most BDCs, it uses borrowed money to amplify returns, which works well in stable environments, but adds volatility in choppy markets. Still, if you believe in the long-term stability of small business credit markets, Monroe may be a contrarian opportunity. At Insightful Value, we specialize in these kinds of deep dives. We look past the surface, break down the essential numbers, and deliver real insights without the Wall Street jargon. Whether you're a seasoned investor or just starting out, we make it easier to understand what makes a stock tick and whether it's worth your attention. You can find more on Monroe Capital and other overlooked investment stories at InsightfulValue.com. Our goal is simple: help you see what others miss and think critically about your next move. If you found this breakdown helpful, give us a like and subscribe to the channel. And don't forget to visit InsightfulValue.com for more deep dive research on undervalued companies that are off the radar, but potentially on the rise.